Hey, everybody. How are we doing out there? Welcome to 12minutetrading.com. My name's Doc Severson. Today is Monday, the 13th of February in 2023. I am joined over here by Dave Lukas, and we're watching the S&P today rally up a little bit into tomorrow morning's CPI report. Dave, did you ever watch the CPI report over the last 10 years or so?
Well, when inflation was at like 1 to 2%, nobody paid any attention to it for, gosh, however many years. It wasn't a big deal. Now, if you look at the expected moves for the week, it's all tomorrow for the most part, so it's become the thing. And so today's been an interesting move, though. Watching the S&P get back over 4,100 with some good conviction as of now. We'll see how the day ends. That's what really matters. But to go from, being at 40.60, 40.70 last week, now 41.30 range or so has been, a nice little move back up. But this isn't unexpected. We needed some softness in the market after the run that we had in January. We needed, I've been saying I think we were on here last week, a 3 to 5% pullback just to get itself into, a position so it can go higher again. It was just too tired on the daily charts and had gotten exhausted. And so what we've done is, one of the things that I have is I have a simple moving average that just goes right in the middle of the Bollinger Bands on my charts. And we pulled back right to that simple moving average in the middle of the Bollinger Bands on these charts. And now we're bouncing off of that again. And the daily charts are getting charged back up. So we'll see what happens tomorrow. We'll see if the CPI is a surprise, like some are saying it may be now, that it may be higher than expected. But I think if it's like a tenth of a point higher, that's not going to matter that much. It's going to have to be drastically higher for it to really scare the markets. If it's lower, obviously we can continue this trend, right? So I think that we've got a little bit more room in this uptrend to go before it really needs to take a bigger break.
Have you seen the consensus number for tomorrow?
I have not yet. I know it's like, well, I've seen several like 6.4, 6.3 and stuff like that. But
the month-to-month one is the one that they really watch. And that right now is 0.5% month-to-month positive.
Yeah.
So we've been looking at, we've been playing around with negative numbers for the past few months, and that's made the market very happy. Because they can obviously see on a month-to-month basis, we're starting to tail down, but now straight back up again. 0.5%, which is a year-to-year 6.2%. Imagine a 6.2% annual inflation. This has got to break at some point here. So, so I guess what the market's obviously looking for, the market's always looking for a Goldilocks number. It doesn't, if they forecast a 0.5% and it comes in negative, I don't know how that's going to be.
Then it's, skyrockets. Yeah. Here's the thing, though. At this point, we were just talking about this before we jumped on here. I don't know if the market cares that much anymore. And the reason being is because the Fed is proceeding with slowing down their rate hikes, and they've signaled it. They've committed to it. Now, they may keep rates at these levels for longer, but you're not going to see drastic continued rate hikes. And one of the reasons they can't do that is because we've now approached a point where it's almost $1 trillion in interest we're paying on the national debt. And that's starting now. Those payments are now starting to have to be paid out in this year. We didn't have that problem so much last year, but it's now starting. So you have a lot of pressure, that's probably behind the scenes happening and stuff on the Fed to slow down, because the Treasury is going to have trouble affording to be able to do that. And the Treasury's actually been making moves to combat the Fed behind the scenes anyways. So it's kind of one of those things where the market is sniffing this out. The bond market still kind of sniffed it out. I think I saw the Fed futures for December raised up to 5.1, probably because they'll keep rates higher for longer.
No, they actually drop.
Did they come
December,
down? Okay.
In December, they actually show at least a 25 basis point rate cut.
So you can kind of see that, that's what's happening out there right now. And that the market's sniffing this out. I think it's just, it's finally just, you get to a point in markets, I think, too, where it's acceptance. And, okay, this is the way it's going to be. We still need to trade and make money. And there's all this money sitting on the sidelines that needs to be put to work. And the big fund guys and all this stuff got to show returns for their investors. And so they shrug a lot of this stuff off and they get back to work. And I think that's kind of where we've gotten to. And as of right now, no real crazy major event headwinds that are in the way. I mean, CPI is CPI, but we don't have another Fed meeting till, mid-March at this point. And, we don't have any major other world events that are kind of new, right? Ukraine's baked in. It's there, it's happening. It's not really, even in eyesight of the markets, right? So there's just, barring some crazy, black swan unpriced event, which can happen anytime. I mean, the markets kind of have a trajectory that they're staying on.
Dave, what I'm looking for and what I'm sort of hoping for is one of the most hated bull markets in history. That's what I'm looking for at this point.
I think you're about to see that with the Dow. I think the Dow is about to go on a serious trend that nobody's expecting. So you can probably pull up the charts and go through that. I know you talked a little bit about that this weekend in one of your updates, but that chart, I mean, all these other ones are pretty exhausted and getting to a point where they've kind of had their run for now and they either have to go sideways or, are going to have to really fight to continue to go up. But that Dow is ready just to go crazy in some direction.
One of the things that both you and I talk about is this sort of notion of a trader progression. Like trading is really easy when you first start it because all you're doing is just following your friends and it looks fun. And usually you're buying in at the very top. And then all of a sudden you get a full education as the market doesn't do exactly what you think. And, like all of these rallies over my career that I've seen, I can't say that I ever got really in at the very bottom of them. A lot of times I'd be like, whoa, this is really scary because I was listening to too much of the news. And so now I'm completely on the opposite side of that. I don't want to hear anything now. And I just want to look at the price. And now what I really, really want to see is I want to see a bull market where people on Twitter are just absolutely going berserk, saying, this is all wrong. This is manipulated. There's no way this should be going on. And we're starting to get to that point. I don't know if you've noticed over the past month or two, but everybody was bearish out there. And now, even now with this little rally, it's like every red candle there coming out of the woodwork going, oh, see, I told you.
This is the end. This is the end.
Look what Michael Burry just said and, posting all that stuff. And so the more that they do that, the more I become convinced that we may be climbing the wall of worry. And that might be starting to happen here. So there's a few more things that I want to see before I fully go on board with that. And so, now might be a good time to go to the chart. Let's go see.
Yeah, pull up the charts. Let's do that.
Okay. So here's the S&P. This is what we're looking at. So one of the most important things that happened over the last few weeks is we have now confirmed with a higher low and a higher high. So that's an actual change in polarity on the weekly chart. That is not insignificant. That is a very important thing. Now, understand that in the context of larger time frames, if we look here at the monthly chart, that's still just the lower high. The monthly chart's like, kid, get out of here. You go away. You bother me. But still, this is pretty significant. Whereas most people are just looking at the daily chart. Now, if you look at the daily chart, we have a little bit more, disagreement here because we have a daily chart which is showing a nice bull flag here. So this is a beautiful bull flag. It's doing exactly what it needed to do after it hit exhaustion at the beginning of February. It's gone through 2 straight weeks of pullback. And, this is actually perfect. It's building up the energy exactly at the right time. The problem here, though, is that the weekly chart's got maybe another week to go. So if we see this thing break out above 4,200, it may be a very short, people have dreams of 4,300, 4,400, and I just don't think it's going to get there. I think we get up to maybe 4,300, if that far, and then we're going to have to go through a significant consolidation on the weekly chart again. So this may be, we may build that even bigger inverted head and shoulders pattern that we looked at. Now, something that you made a mention to is the Dow chart. Now, the Dow, nobody talks about the Dow, at least amongst the professionals, because nobody does. But they were the ones that got the party started back in October. So they broke out here to a higher high, which even on the monthly chart is a higher high. That's significant. And it's going through a triangle consolidation right now. Look at the amount of energy. So this dude is at the gas station and he's filling up his tanks and there's gas coming out of the, out of the petrol outlet. He's just like, it's ready to go. And
and that makes sense. It ran ahead of everything else and got tired before everything else. Then the rest of the stuff followed on and took off. And so it's had its chance to get charged back up. And so now it's its turn to go again. So the interesting thing, like you point out, is you got this triangle pattern and it's sideways, right? It can really kind of break either way. So I think you have to use this. You have to kind of use this as the barometer of where things will go kind of next overall, right? Because the Dow is going to lead. It's going to go ahead by probably several weeks to maybe even 3 weeks ahead of the rest right now. And it's funny because a lot of times the Russell is the leader, right? The Russell is what leads the rest of the markets, but this time it's the Dow. And so we saw a lot of money get cycled into the tech side, into the NASDAQ and, the NDX and all of that stuff. And now that's tired. And so does it cycle back into the Dow and the Dow takes off now? Or is it just new money that's coming in now?
There's so much sideline. There's so much sideline money, Dave. This actually reminds me a lot of 2000 to 2002, because if you go back to those charts back in those days, you can see that the Dow actually, on this monthly chart, the Dow actually stayed really strong and did actually start to build. It just makes sense. People throw their money into blue chips when there's uncertainty. So, tech was on the way out. And there was a war coming in 2003, right? So this is where hey, that's always a great sound. So there was fill-in trades, man. That's what we do. Always be closing. We close all the time. So, but anyway, that's kind of what we're looking at here, is the same thing. We're looking at the same thing. And so, to be honest, I mean, this could break either way, but man, there is so much lean to the upside right now. Now, I do remember this. There was one time in 2011 where we had the same exact type signal coming off the bottom near the end of the year, and everybody was looking to the upside for a break, and the SOB dropped like a stone for about a week, and then it did a slingshot that just roasted everybody's face right off. So,
I think that's what the CPI is going to come in tomorrow and do. It's going to make things move a fairly decent sized move, a couple percent at least on the on all the charts in one direction or the other. But if it's a downward move, don't be lulled to sleep that things are just going to crash back down and this is just a bear market rally, like a lot of people are saying, because it literally could next week slingshot higher if it did that. So
yeah, exactly. So in the greater context of things, remember that we're almost out of gas on the weekly chart. So a lot of times when we're almost out of gas, you can see the market start to anticipate that, and it looks for excuses to pull back and recharge. And so actually pulling back to a 38.2 or even a 50% is not that big of a deal. In the grander scheme of things, if you were to look at this chart, if this were to pull back to 4,000, you would look at that in a year from now and say, oh, well, that was just a normal pullback. Even though those of us that live through it are like, oh my God, here it comes. We're dropping down to zero. But that's what it feels like at the time. But that's what it's supposed to do, because you've got to build up the negativity. You got to get everybody convinced that the world is over. And that's where you build up that negativity that makes it much, much easier to get them to squeeze. And so that's what markets do. That's why markets move, because people are in fear.
Yeah.
So there we go. There's today's psychology lesson for markets.
And it's true. I mean, that's markets. Markets will, and that's why they frustrate so many people, because markets are an emotional thing for people. And so the minute that you let emotions rule the day, then it's going to get you. And that's just the nature of markets. And markets are going to do what you least expect them to do. What you think they should do is not what they typically do. Especially because if you're thinking along with the herd with that, right? If you're along with everybody else that you think markets are going to drop like a stone because we went on a 17% rally in January in the NASDAQ and now it has to drop, and it has to, well, guess what? It doesn't. And you have to be real careful not to get yourself into confirmation biases and just on any one side. Price is all that matters. And so you just need to watch what price does and follow it from there.
Yeah, it's so challenging because that's one of the parts of the progression that people have to work through is to understand that you have to learn to think differently. And once you start to learn to think differently about the market, in other words, instead of like your first reaction is going to be that dinosaur brain, like, oh no, fight or flight, kind of thing. And that's the wrong reaction 99% of the time. And instead look beyond that, kind of separate yourself and detach from the herd and look back and say, well, what is everybody doing here? And sometimes this is where Twitter can actually be very useful because you can just sort of, go through Twitter and get the sort of public zeitgeist of what's happening out there.
The sentiment of the time.
Yeah. And then you want to be kind of on the opposite side of that. Or you
mentioned Beery, right? Beery came out and had one tweet, sell, like a week ago, and everybody freaked out. Everybody's like, oh my God, we have to sell. It's the end of the world, right? And then he deleted it. And then he came back out with another cryptic tweet, and like everybody latches on. But like if you look at a feed, like if you follow a lot of the trading stuff and things that are out there, and you look at a feed of that, you can start to see like Doc said, the kind of zeitgeist of what everybody's thinking. And typically the markets are going to do the opposite. And so that's the key, kind of just not letting yourself get emotionally wrapped up into it, staying logical, understanding price movement, and understanding that you have a big rally. You've broken trend, you've changed paradigm, you've got a lower high, you've got a higher high at this point in time. You've had a heck of a run. You have a nice little 3 to 5% pullback, and you've hit a good level. It's probably continuation of a bull market. That's how price action works, right? It does not have to sell off. And so that's just that is what it is. So don't try to make it anything that's not.
The other thing that we just got about a week ago, and you can see this if you look carefully here on this chart, which is the golden cross on the S&P 500. So this happened right at the beginning of February. You can see the green line is the descending 200. This purple line is the ascending 50. So that's the golden cross. And so, of course, when you hear about people talking on the air about, the golden cross and things like that, people are like, oh, well, it's the time to buy. Actually, it's a perfect time to fade all the retail traders coming in. And so this is, again, why people say, well, wait a minute, I just got a golden cross, and so it told me to buy. No, a golden cross does not tell you to buy. It's just a signal. And your buy and sell signals come independently from, it's almost like a thermometer, like in terms of trend. You have a short-term trend heading higher. You have a long-term trend still hitting lower. Mm-hmm. Will that longer-term trend start to flatten out? And the answer is yes, it is actually starting to flatten out now. So,
really a great time is to watch when the long-term trend starts to turn and go back up again. That's actually your time that you really want to look at. That 200 starts to turn around and head back up, even though the 50 may be above it. That's the time to really, take notice, because that shows that trend, that long-term 200-day trend. So every day, it drops off a day, and that's annoying. So it takes a lot of days to turn that thing around. That's your cruise ship, right? 50 days your speedboat. And so once the cruise ship starts going along the way where the speedboats go, and then you've got a pretty good shift happening, and it's starting, but it's not, it's got a little ways to go yet.
Yeah, and it's funny because it's like I hear all the time, like, hey, have you seen the 131-day moving average? The price keeps bouncing off of that as resistance. It's like, you can form fit this any way that you want to. I mean, I don't use moving averages as anything more than just sort of what is the average of the price trend. The 200-day to me represents the mean, right? It goes under the mean, it goes over the mean, it gets pulled back to the mean on a constant basis. When something's downtrending, it'll pull back up. When something's uptrending, it'll go too far and it'll pull back down. How the price reacts around that 200 is really what matters. It's not a signal. It's just more of, what's the temperature outside? Where's the ocean tide going? Is it going in or is it going out? Not the waves.
Yeah. And markets will run as far as they can in one direction, turn and run as far as they can in the other. And you just, you got to let those things just run their course and take advantage when it makes sense to do so. Right. And again, that's why I love selling options. That's why I love selling iron condors, or especially like big, wide iron condors, against markets, because it's so much less of a headache, right? I don't have to be right. I don't have to say, oh, it's it's time we're going up to I watch these guys on Twitter and they're like, it's got to hit 411. If it doesn't hit 411, then you buy puts. But then it goes over 411. Okay, I'm buying a call. But then 5 minutes later, I'm buying a put. Like, they're tweeting every 10 seconds. Like, I don't want to have to deal with that. I don't want to have to worry about that.
I want to sell options to guys like that.
Yeah, but I mean, once in a while I get a trade that gets attacked. Okay, it happens. You got management rules. You got to deal with that stuff. But it's like, man, I just put on a trade today that's 400 points, 500 points out of the money on either side that expires less than a month from now on the S&P. I got a 97% chance of winning that trade. And, I've got a great return coming from it. It's just to me, and I hope some of you, relate to this. It's just so much easier, more consistent, and less of a headache of a way to make money in the markets. So I don't want to have to be right. I don't want to have to worry about that.
And we're using the exact same business model that insurance companies have been using for hundreds of years, is that we're willing to receive other people's risk from the market. We're taking on that risk and we're being paid for it right out of the bat. Just like your policy check that you send off every month. You don't even think about it. You just write the check and say, I don't want this risk. So some people are taking that and, we're taking it on. Now we're just making sure that we don't let that get too big, but we don't want to be selling hurricane insurance on, the east coast of Florida when there's, Irene bearing down on it or something like that. That's not what we want to do. We want to, be selling it during the months like January and February and things like that, and not September.
That's right. And that's why there's sometimes we just don't trade. Like I didn't trade my weekly, trades like you do every day this week. I think you took today off too, ahead of tomorrow, where you've got 80% of the move for the week baked into one day. Yeah. Let the move happen, then take advantage of it. Let the storm go through, then come in and sell the insurance. Right? It's the same type of thing.
Yeah, we're going to let the train leave the station and then just jump on once it starts. We're not going to just sit there and wait for it to leave. So otherwise, you get run over. So. Yeah.
There's no point in stepping in front of a freight train, right? Yeah. Let it show you direction and take advantage. So
I guess what we're trying to say is this stuff isn't as hard as you think it is, but we make it hard just because we're human beings, right? We always end up making this stuff hard. And so what Dave and I have done over the last 20 years or so is like we found ways to make this simpler on ourselves, and we just do kind of the same thing day after day. We just kind of crank the wheel, and there we go. So that's
actually a great way to end it. Honestly, for today, I mean, I think that's a great message for people. I think Einstein said, keep it simple, but not simpler. I think that's really what it comes down to. The more you trade, statistically, the more you lose. The more things you throw in a chart, the harder it is to make a decision. Keep things simple, learn price action, and pick trade types that you don't have to call a direction or be right. And when you sell, you get paid. So it's nice to get paid up front for taking on a new risk. So, I mean, that's our philosophy. So
for you intrepid souls that are out there watching us live, thank you very much. Appreciate your, and you can actually be notified if you go to our YouTube channel and you click the notifications bell, you'll be emailed when we're about to go live. So the next time you do that, and if you're not subscribed, please consider doing so, because it doesn't cost you any money. And it helps spread the word. And go ahead and click the like button if you get a chance as well, too. So if you're not watching us live, if you're watching this on a replay, we'd like to thank you for tuning in as well, too. And consider catching us live. And we'll always take questions during these things. It's not just Dave and I talking, although this is our chance to catch up for the week. But we love to answer questions because we love what we do. We love markets and we love helping people be successful. So we hope to see you next week. We'll probably be here next Monday, I suppose. Next Monday, I think. Yep. And so.
Well, actually, is next Monday a holiday?
Oh, it is. That's true. So we're going to, it's going to be next Tuesday.
Although we still could go live and talk about what's going to happen, but.
No, I got to be talking with my accountant and figure out the whole tax thing. So.
Day off.
Yeah. my whole joy of taxes. So, yeah, next Tuesday it is then. So thanks, everybody, for tuning in or catching us on the archive, and we will see you next Tuesday. Thanks, everybody. You guys take care. Yeah, I'm glad you